Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 4th of December. I'm Daniel Lam, your host for the podcast. It is the time of the year when many of the market thought providers would be publishing their annual outlooks. While many are remaining constructive on risky assets, they do highlight the risk of market volatility over the next 12 months. The number one risk is no longer the slowdown in US economic growth, but the narrative in AI. Now, in a typical late cycle, valuation in equities is expensive. You will see days of small positive returns with risk of drawdowns. Nonetheless, structural themes are usually supporting such late cycles, and valuations can stay elevated if there were to be no challenges on such drivers. Clearly, the key driver in US equities right now is AI. Now, unlike the dot-com bubble that we saw back in the late 1990s, earnings are justifying the rally in US technology stocks. So a move in the narrative in AI due to a change in sentiment, questions about the high capex spending, and how they're financing it, i.e. do they need to re-lever instead of using the self-generating free cash flow, those would lead to rising correlation amongst the large-cap technology stocks. Given their sheer size in the US and also amongst global equities, AI would be effectively a macro rather than a micro driver and be able to influence market volatility immensely. Historically, S&P 500 has shown a positive relationship between valuation and subsequent volatility, which means that volatility is probably going to be higher in 2026 given today's lofty valuations. Single stock volatility has been rising over the last few years, but there's still room for that to go higher, given the increasing drawdown risk, and the volatility level is still below the levels saw back in the dot-com bubble. We are constructive regarding the AI theme, but investors should be prepared for occasions of volatility over the next 12 months and be ready and not be afraid to utilize such occasions and be adding on dips. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.